on.
So let's quickly look at, recapping yesterday's session. And yesterday's session, what we did was we basically looked at a couple of things with regards to, the unit business environment. Now, one of the key things that we looked at was to try and understand how businesses, are formed, what are the financial and, legal requirements in particular, and how do we categorize these type of organizations or businesses when they are formed. Then we also looked at, the role of stakeholders, different type of stakeholders within the organization. We did take an example of Unilever as an organization. And the idea was to try and understand from a big scale point of view, in large scale organizations, the type and, the different types of stakeholders, and obviously what roles and responsibilities they look at. And then lastly, we also looked at how the objectives of stakeholders are quite different. So when we look at government, obviously they are looking at the company or the, business publishing it, the accounts, paying the tax. If we look at shareholders, they want more dividends or, return on capital. When we look at employees, they want obviously their salaries and, they want a good, safe working environment. So, and then suppliers, when we look at, they want their invoices and obviously payments to be done on time, and obviously longevity of business. So the idea of understanding that was to give it a bit of a start, and then get into the realm of understanding a bit of economics to know the basic elements of, how the companies are formed, the types of organizations, and how they operate, what sector they operate, and the stakeholders and their expectations. Now, taking that forward, what we're looking at doing today is going to be a combination of studying Learning Outcome 2 and Learning Outcome 4. Depending on the time, how much we are able to complete, we will look at that. But it's the slides that I have today is about about 51 odd slides, and we'll skip through some of the slides so that those can be something that you can read over along with the pages and the email that I will send to you today after the 2 sessions that we've done. Now, today what we are looking at doing is we are trying to understand in a very brief overview different types of economic systems. And when we look at the different types of economic systems, we want to understand how the government actually uses these economic systems to be able to, to be able to, basically control business activities in the economics, of a particular country. And then we will understand, very briefly, the impact of competition. Look at one of the models, to understand how competition affects a business, and then what are the regulation activities which the organizations have to follow when they do their, usual activities, which is either producing goods or services. Then towards the end, what we want to do is extend this understanding of ours, of understanding a fiscal and a monetary policy and the financial instruments which the government uses to be able to kind of, regulate the economy and the growth in the economy, the GDP of the country. We'll extend that to understanding how some of these things internationally affect a particular country when they trade globally. So when you look at UK in particular, it is a part of European Union. It trades with a lot of other countries. What we want to understand is how businesses actually, trade globally, and what kind of agreements and rules and regulations they have to adhere to, and how, because if they trade globally, how the, how some of the global factors or how some of the environmental factors, policies, legislation, different trading rules and regulation affect those businesses. And then finally, what we will look at towards the end would be to understand what are the EU policies and how they impact UK businesses. This is more or less quite important now because UK is leaving the European Union and we are going to take back control of policies which have been incorporated into the system, or UK law will have to be unwritten, or will have to be overwritten by UK law again, and that would mean that some of these policies would impact UK businesses and the economy, adversely or positively and adversely. Now let's look at understanding the term first, which is looking at economic systems. So that's the flow that we want to look at in this presentation. When we look at learning outcome 2, we are looking at basically studying the economic implications of operating, a business, and that in learning outcome 2 is looking at a particular country, and in learning outcome 4 we are looking at operating that business globally. So when we look at different types of economic systems, I think one of the key things that we look at is we need to understand what is an economic system. So if you look at the definition of economic system on, say, for example, like Wikipedia or some of the other sites, you will see that the economic system is nothing but a system which actually produces goods and services from the resources which are available, and then once the goods and services are produced, these goods and services are then distributed geographically across various cities, countries, or continents. And this particular system, which allows everything to be done from say taking the raw material, which is nothing but resources, doing some complex operations in terms of some sort of operations to produce the goods and services as an output, and then selling them across or transporting them across or making them available across to different people, consumers, cities, countries, geographies, is an activity which is going to lead to results in terms of creating money or wealth. And that is why this is termed as economic system. Now when we try and kind of plot the economic system vis-a-vis within a country, what you do plan to see is that what tends to happen is this kind of a quadrant comes across. So if you look at a democratic government, or say for example if you look at communism, which is present in countries like China, Burma, which is kind of an authoritarian regime, what we do get to see is that there are two swings which get created. And on the economic system side, there is some free market and there is something called planned market. So if we basically study and put this across onto a some sort of a chart, what we get to see is that between the two political and the economic system, we do see that there is a dimension which gets created wherein either the system runs with free market and democratic setup, or it runs with planned and authoritarian setup. And this is important for us to understand because the policies of the government, typically would look at, say for example, understanding certain things in terms of how they will shape the policies, and these policies then will basically regulate the systems or processes, for example, the fiscal instrument and the monetary instrument which the government uses to be able to then, influence these changes. So in terms of, let's put it this way, okay, we'll answer that question on yellow one towards the end of the chapter. But in terms of, these systems, what we understand is that when you look at free market versus command systems, we also look at something called Mixin transactional system. So we need to think of countries wherein you will see this kind of a setup working. So when you look at free market and authoritarianism, or if you look at free market and democratic, setup, and then again you look at democratic and planned and authoritarian and planned. So if we look at some examples here, when we look at free market and democratic setup, we look at, America, for example, we look at India, for example, we look at all the other countries in which there is a democratic setup in terms of the government is elected democratically, and the government is then having the supreme, power through the parliament to be able to set policies and systems in place which allow, the production of these goods and services, and that's how the economic system works. Now, in some cases, you will see there is a free market, but there is also an authoritarian side of the political setup, and that controls or regulates certain movements or certain types of, policies and procedures in place. And that would primarily come across in the case of countries, which would mean that, you have so you have what you call, countries like China, for example, wherein you will see that the government tries to control the setup in terms of creating progressive policies which allow businesses and growth to happen, but intervenes in places wherein, say, for example, in this case, they control the currency evaluation and for example, demonetization of the currency. Now, when we look at authoritarianism and planned, then we look at countries wherein there is a absolute dictatorial authority. That means these countries, for example, are ruled by dictators, or the policies of the government are predominantly, decided by. Yeah, I can hear you now. So the policies of the government there are predominantly decided by somebody who has absolute supreme power. So when we look at countries like that, we will see examples of countries like Zimbabwe, for example. We look at countries like Burma, wherein there is a military regime in place, and this military regime then plans policies and uses the instruments, which are fiscal instruments, to be able to control the output of the economy and how the economy actually grows. Now, if we have to understand that how economic systems work, we basically look at that there is a lot of interdependence between companies or organizations which actually produce goods and services, and consumers or household which buy these services. So there is an equation of demand and supply that we get to see when we talk about economics in particular. So here, if we have to look at studying some of the economic systems, what we need to do is we need to understand what are the various institutions, agencies which work within the particular system, within this particular remit, to create a system. And that is what is kind of depicted on obviously this particular slide, wherein we do get to see that there is a demand for certain set of products, be it, for example, food products, clothing products, grocery products, any other things that you look at. So if you look at the housing market, there is a demand from the consumers to buy and own their houses, and this demand actually then pushes suppliers or producers to actually produce goods which help in fulfilling that demand. And in order for them to fulfill this demand, what they have to also look at is they have to factor in a lot of services which are provided by intermediaries. And these services could be, for example, if somebody is looking at building a house, or they are looking at buying a house. Now, the house might be developed by a builder or a developer, but not all the things which go into a house might come in from the developer directly. So when you look at, say, for example, fitting a kitchen, or when you look, for example, fitting a bathroom, then in those cases, some of these things which are required to be fitted into the finished product might come in from intermediaries or suppliers. And that is where, you will see that a lot of producers who directly are able to produce goods are then having to sell them through intermediaries, so that it finally lands up in the hands of the consumer. So this particular factor, when we look at demand and supply, and we look at production of goods or using raw material, we do get to see that there is a interconnected chain which gets formed between consumers, producers, suppliers, and distributors. And this tends to work in a system which is also called as, which can also be termed as an economic system, because everybody in the system gains, because every time a service or a product is sold, money is exchanged, and that money exchange leads to somebody providing a service and in return getting paid for that service. And that will also constitute something like, say, an economic system. Now, in order to basically understand various, over the years, what has happened is different types of economic systems have been, recommended by various key economists. And when we look at, various types of systems, we will look at just a few, so that we know and we are aware of this. Like, we'll use the Keynard, economic system. And here, these systems have then become a part and parcel of economies or the government setups, in terms of how they use those set of economic policies to be able to drive consumption, drive demand, and demand which kind of then has supplies coming in from producers or suppliers to be able to fulfill that demand. So various things that we look at when somebody buys something or when you sell something, you will see that there is a flow of income pattern which gets created. So if a household is buying a lot of things and it's being produced by factories in the background, you will see there's an income flow which tends to happen, and that also constitutes something called, an economic system. So a household is buying a lot of things, and in turn these things are being produced by firms. So when you buy, you pay money, and these firms basically supply you, with the goods and services. Now, if we kind of highlight this into where and how the money is exchanged and the instruments which come in, what we've done is here, if you look at the household, what tends to happen is the household, there might be one or two people working, or several people working in the household. So when they get the income actually comes into the bank, or maybe some sort of an institution where the money is stored. Now, some part of that money will be directly going into expenses in terms of goods and services they buy. Some part of that could be savings that the household is saving every month in terms of bonds, or savings account and things like that. At some point in time, when you're earning money, you're also paying taxes to the government. Now, these taxes which are being collected by the government are being collected because they are looking at setting a fair system in place which allows the exchange of goods and services to happen, and also some of the primary services to be provided by the government. Things like the fire service, the police, basic services like hospitals and other things that you have. So government has to have money also coming in, and this then comes in the form of collection of taxes. Now, if a household buys goods, like if you buy through Amazon or eBay, and if they are not based here and the goods are coming in from abroad, at times you will see beyond a certain value, some of these goods might also incur tax, and that tax would be something like an import tax. In most of our countries, when you try and import a car, what you will see is there's some sort of a duty which is levied on that car, because that is a fully imported item which is manufactured outside the country. So in that case, government also looks at getting hold of a tax, and that comes in the form of duty. Now, duties are of different types. I won't get into details here. There might be excise duty, customs duty, assess, or something like that, which would be applied on different types of products and categories that you're importing, if you're importing that from abroad. Now, in order to make sure, so this is looking at this side of the equation, wherein from a household perspective. Now, if I look at the equation from a point of view of industry or a producer's perspective, what tends to happen is, because they are producing goods in large scale, they require, for the business to be set up, they require a large injection of cash or investment, and that investment can be given or provided by the bank. They can also look at that investment coming in from that investment coming in from the directors or the board of the company, in terms of savings if they have, or profits which the firm has made in the subsequent years. Now, sometimes you will see the government will also, in order to boost manufacturing or production within a particular sector, within the country, they will also give exemptions in terms of tax, excise exemptions, or rebates, which will help promote the growth of industry, because this is a cycle. So a lot of people working in the household are ultimately working somewhere before they make a living or before they get some income. So in order to create a balance, the government would in some cases also look at, when you look at promoting certain types of industries within a country, the government normally, in order to invite investment, they give a lot of what you call soaps, as we call them, or gives them a lot of planned rebates, which could be in the form of taxation, it could be in the form of decreased VAT that the business need to pay, or in the form of a decreasing scale of taxation which could be applied. And when the business exports goods, because this is leading to bringing in international income into the country, that would also mean that if a business is exporting most of its products and services, then the government will also provide some incentives on that side to the business to increase exports, which would mean that they are able to get foreign income, or foreign capital coming in with regards to some of the services being exported. Now, this is to understand the cycle of how a system works. And the expansion of this could be done to understand how the economic systems work within a country and then across the geography. So, for example, how UK trades, how businesses in the UK trade amongst themselves when you look at consumers buying services. And then we expand this to EU or European Union, where UK manufactures, imports, and exports a lot of goods and services, and how in the government in the middle actually this transactions by levying certain say taxes which allow it to collect some revenue, and in some cases it allows the businesses to collect revenue, and they also charge tax, and this then allows the regulation of the system to happen. Now let's look at this was visually understanding. Now let's look at understanding a few definitions. So when we look at economics, what is economics? Economics is nothing but we look at certain factors which basically affect business when you operate within a particular environment, and this tends to be more or less say a definition of, I would say, economic. Now economic activity, when we look at so when we talked about, say, economics, we talked about, a system wherein there is a distribution of income which can happen, products and services, demand and supply. And because there are lots of different, types of people working within that system, which are, people providing raw material, people processing that raw material to produce goods and services, and then consumers buying those goods and services. So you have suppliers, distributors, consumers, and the government playing a part in terms of creating that whole system. Now, when we look at that in particular, what we do get to see is that this is how the system would tend to work. So in terms of definitions now, what we want to look at is we want to understand the definition of, say, economics first. And in that case, when we look at this is predominantly a science. And when we look at economics being a science, what we do get to see is that this is defined as a social science that studies the production, distribution, consumption of goods and services, and it focuses on the behavior and interaction of economic agents and how economies work. Now, in order to control some of these various aspects of the system, the government has a lot of policies that they put in place, and some of these policies is what we need to understand at this stage to understand the workings of an economic system. Now, there are lots of things which affect businesses, and some of the things which affect businesses could be if there is a recession in the economy, that means the demand typically falls from the consumers, then businesses also slow down the production of goods and services. And if you see an increase in demand happening, we generally tend to say that, okay, the economic output is rising. That means there is a lot of demand for goods and services in the market. And the manufacturers, the producers, they generally feel quite buoyant. That means they are quite positive that the economy is going and there is a lot of demand and a lot of growth happening in the business. Now, sometimes you will see certain things like we will understand inflation, which tends to, tend to increase the prices. Now, inflation is something which we will look at also in terms of definition, but inflation in general looks at, if there is low inflation, then we normally see low prices in the market or, a stability. But in terms of, if you have to define inflation as a term, what we do get to see, this is an important component of the economic system in which a sustained increase in the price of a particular product or service over a point in time can lead to rise in prices, for that product or that category. And this tends to happen when we get to see the fluctuations happening in the exchange rate, fluctuations happening in the demand and supply, or the consumption patterns of the consumer, and this then affects what we call the real price or real buying power of the consumer. So in a very simple sense, how do I define inflation? I define inflation if we do see a steady rise happening in prices of products, which tends to put pressure on you being able to buy, say, for example, milk. And if we see a common product like milk or petrol, for example, the fuel that we use in cars, if we do see a steady rise of this happening, then what tends to happen is if the price of fuel rises, because a lot of transportation distribution happens using the transport sector, if the price of fuel begins to rise, the companies who are transporting and involved in haulage of these goods across various cities or to distributors, that cost begins to rise. And when that cost begins to rise, at some stage, these companies will tend to pass that price rise to the next particular participant. So if I look at a distribution company which has a lot of transport and trucks, and they transport a lot of fruit and veg coming into the ports, and from that their increase in the price of fuel, like in the case of petrol and diesel, if the price of petrol and diesel rises by a few pennies, what we do get to see is they're able to absorb. But if it keeps rising, then at some stage they start to increase their price for the services that they are providing, which is distribution. And because everything moves by roads in most countries in terms of distribution, that rise in price leads to a ripple effect, which means that prices for all the commodities over a point in time starts to rise. And this is basically the effect of something called inflation. That means a sustained increase, which is happening in the general price levels of goods and services that a consumer buys. And then also we look at things which the government looks at in particular. Is in some countries the government sets the basic minimum wage, which people will get if they work at an employer or at a at a site or a factory or whatever. So labor laws and wages also are a key part of economic system, because you do not work for free. You work to earn a living. You work to basically earn money, and that is where in some countries you see, in some economic systems you see, the government steps in to regulate the basic wage that the person receives when they work for a particular type of employer in a sector. And then lastly but not the least, we look at policies and procedures which the government uses to set the economy on some sort of a growth path. And these policies we look at are legal policies, fiscal policies, and monetary policies. Now this all, when we look at in as a group or as a subset, or as a whole, not as a subset but as a whole, is nothing but economics. And when we consider all of these factors, things like inflation, growth, demand, supply, wages, policies, law, regulation, government policies, this then constitutes something called an economic system. And this particular constitution of the economic system actually affects businesses, because if there is a change in policy, then it might or might not affect business, but the businesses have to check. If there's a increase, if there's a change in the inflation rate, the exchange rate of the currency, when some of the goods are being exported or imported, the businesses are affected. So if the dollar, which is considered as an international currency for trade, if the price of the dollar set against the pound actually decreases, what we see is, if we are importing everything in pounds, we do get to see that you are able to, your imports are affected, because the prices which you are trying to sell goods, your price in the market has gone down, and that means that there is a pressure on the producer to be able to absorb some prices. But if that exchange rate increases, then what tends to happen is you see a favorable trend wherein the manufacturer is able to make more money or more profit, because your currency is more valuable against the dollar. So let's understand some of these things in a few slides going forward. And when we study economics, we need to study these key terms like demand and supply. So what is demand? It is it is defined as basically something which influences affordability, competition, the availability of substitutes, and these things primarily, define something called the gross domestic product of the country. Now here, demand is basically related to consumers, but also can be related to producers, suppliers who have a demand for producing some raw material, or providing some raw material, or using that raw material to be able to produce goods and services which they supply further into the ecosystem of the chain. Now, supply is basically influenced by raw material, because if you see that there is a downfall in terms of availability of certain material, the price of that commodity tends to increase the market. So sometimes you will see that if there is a strike and the petrol stations or the gas stations, if they go on strike, what will happen is very few of them will be operational, and it puts the pressure on the few which are operational. And what they tend to do is they increase the price of the fuel in the gas station, because they are trying to rationalize on the availability, and they know that the supplies from the refinery might not come. So in order to kind of influence sales, what they tend to do is they basically increase the price of the fuel at the gas station. So this kind of a thing, when the supply is less, the price increases, and when the demand is more, and the supply is meeting that demand, you will tend to see that there is a kind of a flattened price which is normally there. Now the government basically uses and understands and studies these demand and supply systems to be able to create effective policies which then regulate fair pricing within the market. Now, changes in demand and supply can basically lead to something that we study called demand and supply curves. And here, an elasticity of demand curve, price sensitivity curve, and we look at these kind of curves, which basically tend to be what do you call phenomena that we need to study to understand how the government then steps into control if they do not want the market to run away with increases in price and obviously affecting inflation. Now, this at an international level tends to work more now, because a lot of businesses are global, and a lot of material being imported by producers or companies which produce raw material comes in from abroad in certain cases. And here again, they have to study, and they are dependent on obviously studying things like the exchange rate, inflation, the availability of goods and services, how the movement is happening. And because sometimes you will see companies which export a lot of goods or import a lot of goods to create their final product, they will, depending on how the exchange rate fluctuates and how the conditions in the particular countries from which they are working with, they tend to kind of import sometimes goods in bulk, because they are anticipating some adverse conditions. And that is where what they want to do is they want to minimize let's put it this way, they want to minimize disruption in the production of the goods which they are doing. And in order to minimize that, what they do is they import more raw material, because they know that the uncertainty in that country might lead to disruptions in supplies. So when you look at an example here would be, when we look at the conflicts which happen in the Middle East, and if it tends to soar up, you will see that the price of crude oil or the barrel, Brent crude actually starts to increase, in the stock market, because they do feel that increasing tensions might lead to, reduction in supplies by various countries, and that would mean that that price would not be sustainable. So what happens is, when the Middle Eastern war and other things broke out, we saw that the price of crude oil surged drastically, and it reached about $160 or $165 per barrel of crude oil. But now, when everything is stabilized in the Middle East, or at least returning to normalcy, say in countries which are big producers of oil and natural gas like Iraq, what you do get to see is that the price of Brent crude has come down to, say between $60 to $65 a barrel. So because some of these things that we trade and we buy are dependent on international situations, and this means that companies like British Petroleum, we look at Shell, Texaco, Chevron, Texaco, these large producers, because they're dependent on getting supplies from the Middle East for oil. There, if the situation is not stable enough, then in the stock market these prices begin to rise, because their operations are global. So their interactions in terms of procuring raw material, which is the crude oil, is important for the running of the business. And in those cases, if the prices begin to go high, the market prices of the finished products also gets affected at the pump. Now, if we have to plot this cycle, in terms of output and time, or in terms of input, output and time, what we do get to see is that this is how it will look like if you plot it out. Now, The slump means that the demand is more or less, decreasing, and decreasing demand, if it happens for over a period of 12 weeks. So what tends to happen is, if there is a fall in demand, or if there is a fall in the economy for a period of 12 weeks, and if it continues after the 12-week period, then continuous 12 weeks period, then the economy is deemed to be in recession. That means the output, the growth in the output is not happening, and the demand from the market or from the consumer is decreasing, and that leads to a recession. So these are first signs that if the economy is not growing, what we do get to see is that if there is a continuous contraction or decrease in demand in the economy for 12 weeks, then technically speaking, it is considered that the economy, or the economy has actually gone into recession. Now, for it to recover, again, the recovery has to show 12 weeks of incremental growth. That means every week, every month, or every 3 months, or every 12 weeks, there is growth happening in the market. That means the demand is steadily increasing, and if it continues to happen for a period of 12 weeks or 3 months, then it is said that, okay, the recovery has happened, and then it is on a upward trend, wherein the demand keeps on either increasing steadily, or it increases or remains the same at a level wherein if there is a fall, then it increases again, but there is no continuous 12 weeks of fall, and that is where we say the economy is, booming. So these are terms that we need to be aware of at the very basic level. I am going to send you a bit of a handout that will allow you to understand these terms and understand them in a bit more detail, so that you have a good understanding at a foundation level at this moment to understand some of these terms, both from a definition, but also from a point of view of understanding and relating it to one country or economy. Now, let's look at, we are looking at, understanding some key terms which are still related to, the economics part of, the task 2.1, and we'll get into 2.2 shortly. But what do we look at GDP? What is GDP? GDP is nothing but gross domestic product. So how do we define, gross domestic product? Now, gross domestic product is basically nothing but, the sum total of all the goods and services being produced by, everybody in that particular market would be summed as something called, gross domestic product. That means farmers producing, companies producing, factories producing, everybody who's producing, the sum total of those activities, if it is measured in some sort of a monetary value, then that monetary value which has been put together on the production of those goods and services, if you are to sell them, would be termed as something called gross domestic product. In a very simple definition, that is how it is. Now, in terms of how it is calculated, now this is calculated on the basis of, the total monetary value which the country can produce. And that, how is that total monetary value coming in? That monetary value comes in terms of, the output. So if farmers are producing tons and tons of, say grains, factories are producing a lot of material, which all has monetary value. And that output, if I put it together from agriculture, all the 16 sectors in the economy, there are 16 different sectors identified in the economy, like agriculture, manufacturing, energy, technology, education, services, financial services. There are 16 such sectors in the UK. So when you look at that, and if we calculate all the sum total of that output, that would be constituting something called GDP, or gross domestic product. Now, GDP can be measured in 3 ways. Now, how do we measure, and why do we measure GDP? Sometimes you would have heard the terms like, the GDP of UK is $2.2 trillion. Now, the reason why we look at GDP is we want to understand what is the economic output of the country. How much does the country produce in terms of monetary terms? So when we look at America, that by far is the biggest country in terms of economy, in terms of economic output, is because their economy is worth $16 trillion. We look at China after that, that's $4.4 trillion. So they are the second biggest economy in the world in terms of the output of the goods and services that they produce. That means sum total of all the goods and services in terms of monetary value is measured as the GDP of that country. So the third is Japan. I think it's about 3.9 trillion dollars. Then you have Germany, then you have UK, then you have India, and then you have France, Italy, and things like that. So in terms of the economic output, that means how much of skilled labor that the country has, how much of production services the country produces, and the sum total in terms of monetary value. That is one measure, which is output. Then we look at expenditure. How much does the income, per capita income as we call it, what is the per capita income? That means how much does an individual have in terms of money to spend. So this is defined as expenditure in terms of measure, and this is the value of goods and services purchased by a household or by government in terms of investment. So here what we look at is, if you as a household have two earning members and you have say £100,000 as income in the house, then your expenditure or your earnings potential is 100,000. That means you can spend that money, and your spending that money allows you to purchase goods and services. So your expenditure measure is the value of goods and services that you can buy. So you can buy goods worth £100,000 on an annual basis, because obviously these salaries are at an annual level. And then the third measure is income. That is the value of income generated mostly in terms of profit and wages. So if you look at profitability of a business, sometimes you will hear the terms that, my business is quite profitable, and sometimes people talk about it in the way that, okay, the gross profitability of the business is 30%, 40%. And that is what it means, is that net of all expenses, that this is the money which can actually be transferred into savings, or this is the money which can be reinvested into the business. And that is where you look at income measure in terms of GDP. Now, when we look at all the three, in UK, obviously there are lots of agencies which basically produce this data, but the Office of National Statistics is the organization which is tasked by the government to measure and come out and publish GDP figures for UK. Now, these GDP figures typically tend to be quarterly. That means the Office of National Statistics will release some of these forecasts and figures, or on a quarterly basis. And these figures, when they are released on a quarterly basis, tell us about the condition of the economy, whether the economy is growing. Is it because it's a 12 weeks projection, and it's based on the 12 weeks data which they collect. And this tells whether the economy is growing, prices are rising, stable, or decreasing, and that determines the level of inflation. Now, how they collect data in different countries, it is different, but in the UK, the Office of National Statistics actually collects data from 6,000 companies. They go across to 25,000 companies in the services sector, 5,000 retailers, and 10,000 companies in the construction sector. Now, this output is generally a combination of data which is directly collected by them, and this is collected from key sectors which contribute towards the job creation, wealth creation, and production of goods and services in the economy. Now, data collected from certain activities like agriculture, energy, health, and education. So when they say, when I put this on the slide, what I mean is that the 16 sectors have an appropriate representation basis the output they have in terms of contribution to GDP. Now, when you look at companies like which are in manufacturing or in services sector, they contribute more in terms of percentage because they employ more people. The value of the businesses or the services they provide are higher. So depending on the contribution they make, they are then included in this figure, and that is where the GDP actually gets calculated. Now, this is an old chart, but I will include something new because this showed the impact of financial crisis on the UK economy, wherein there was a negative growth in the UK economy for a number of consecutive quarters, or every 3 months. So we had about 12 consecutive quarters in which there was no growth in the economy, and that meant that the UK economy was in recession during the financial crisis. No growth happening, no demand increasing in terms of services or from the consumers, meant that the market was contracting. Now let's look at some of the instruments in terms of, once we've understood economy, economic definitions, various things that we need to know in terms of who are the key players in the system. What we need to know is to influence business activities. Now, some of the policies that we will study would be fiscal and monetary policy. Now, before we do that, let's understand there are two types of economics. One is macroeconomics and the other is microeconomics. Now, macroeconomics essentially means that, things which affect the business activity from an external perspective. So the field of economics that studies the behavior of aggregate economy, that means it studies the, economy from an overall perspective, would be termed as something called macroeconomics. Now, macroeconomics examines various, phenomena or various factors which affect and make the macroeconomics. One is national income, the growth rate happening in the economy, gross domestic product, inflation, and price levels. So when we study these things, and when you hear about these words or definitions, you should immediately click, and your mind should immediately think that this is more or less a discussion on macroeconomics or factors which will affect the business externally. You cannot control inflation as a business. You cannot control the exchange rate, vis-a-vis dollar and pound. You cannot control the overall, output of the other companies or other sectors which actually contribute to the overall growth of the economy. So these are things which you cannot control, and that is why it is external factors. Now, microeconomics is something which is focused on factors which are directly affected by, the firm itself. So they are internal to the firm, and people making decisions inside the business or inside the company will actually affect the company itself. So this is factors which are internal to the organization, whether it's decisions, whether it's, the board or the directors making those decisions. And these decisions which are internally taken and can affect the business will be studied under microeconomics. Okay. Now, sometimes you will see, in terms of the wider remit, what tends to happen is that because most economies are now interconnected, that means you are dependent on your neighbors or other countries to be able to produce and provide you raw material, resources, manpower, because of the globalization of, the size globalization of the businesses. What we do get to see is that a lot of governments over the years have created a lot of economic treaties or consortiums. And these treaties or, let's put it this way, these treaties and, economic trade areas or zones have created favorable policies for those countries to be able to exchange goods and services, work together to be able to increase output. Now, when we look at this is being done from a point of view of, having a leverage, one. So when you look at, say, an example here of European Union, why do you think European Union got formed? And why did they look at, most of these countries coming together? Because each of these countries individually did not have enough power to be able to, influence policies or do favorable trading with other countries. So the economic area which was created when some of these companies signed the European, Economic Area Treaty in 1951, they kind of signed on to the fact that as a region, we will trade and create policies which will help us to trade and obviously grow the businesses in various countries. That meant that they wanted to also look at removing some of the barriers which were, regarded as barriers for trade, because these countries were all interlinked or, kind of very close to each other in terms of neighbors. What they meant was that some of the resources, raw material coming in from other countries, and then goods and services being sold, produced by one country, being sold in other, they wanted to remove barriers, which would mean that it allowed free movement of goods happening across, this economic area. And this was then termed as the European Economic Area, EEA as we call it. Now, the reasons why some of these things were created was that they wanted to, kind of look at having a greater control on pricing, in terms of, things like inflation, also influencing employment. That means at a later date, they kind of signed into the fact that there was a freedom of movement which was allowed across these countries so that people could go into different countries to be able to work. And this then removed barriers from a point of view of employment. Now, in order to kind of still have the real local government or the national governments to still have control on their legislation and, obviously drive demand and economical control, the monetary and fiscal policies, are instruments which were, obviously used to have a direct control on some of the key aspects of, the policy setting which the government or the parliament of these countries do. So let's understand these two policies in a bit more detail. Now, what is fiscal? Now, when we look at the word fiscal, when we look at the word fiscal, we talk about, essentially something which is related to, say revenue, which is currently related to, say, when we look at fiscal policy, we basically talk about, things which are related to revenue and taxes, which the government actually collects. So it is a word which basically came across from, the treasury, or the, the central bank in most countries. And here, this particular word usually refers to government finances. So when we talk about fiscal policy, we talk about what we are meaning is actually government finances. That means the budget which the government creates every year when they announce budgeting reviews, or when they announce an annual budget. This is basically talking about government spending and finances, or government revenues and collections. So here, in order to look at stimulating growth into the economy, to basically drive the economy further, the government looks at creating favorable policies which kind of promote the growth of businesses. So when we look at fiscal policy, we talk about things which include things like say government spending, how much of finance they will normally have in terms of their budget, and this then contributes, or basically is formed over something called the public finances, which means the revenue they collect, the spending or the expenditure they do, and what is the money that they allocate to public authorities or public sector franchises. And this overall then helps to kind of drive public finances in a country's economic policy. Now, the monetary policy is basically something which the central bank or the central bank of a country basically follows. And this, when we look at monetary, is exactly the opposite of fiscal, which means it is linked to money. And this here is basically the money which the country or the central bank of that country actually prints and makes available in the economy. Now, the more money you supply into the economy and the more circulation it has, it promotes more of interaction in terms of trade and other things which tend to happen within the particular country. Now, monetary policy also looks at things like the exchange rates, which talks about things like let's put it this way, borrowing, which you can do from the central bank. So here, the monetary policy is nothing but a process by which, the central bank basically controls the supply of money. And when we look at the supply of money being controlled, it can increase or decrease inflation rate and interest rates. So if there is a lot of money available in the market, what happens is that means everybody has money in their pockets to spend. That means it could lead to the rise in prices, because it is leading to the rise in demand. That means people having a lot of money to spend. But if it means that there is less money in the market, that means sometimes you will see that because the money is less, the demand also tends to kind of contract. Now, during recession, an example is what happened during recession. During recession, what happened is that the money supply was tight. People were trying to save rather than spend, and that meant that the supply, demand in the market contracted, which meant because the demand was contracting, the inflation also fell within the economies, within the countries, and that meant that money supply became generally tighter because people were not spending, they were saving money in the bank or saving money with themselves. That the supply of, or the circulation of money basically went down. So lower interest rates, and because the money supply went down and there was not much requirement of money in the market, that means the banks had to also reduce rates so that people could borrow money cheaply, and then that meant lower interest rates. Now, lower interest rates in any economy actually encourages businesses to invest or take money or loans for long-term investment basis from banks, and that would mean lower interest rates are good because that helps people borrow money from the bank, from a point of view of firms and big companies which want to develop infrastructure, products and services and things like that. Now, when we look at a contraction, in say for example demand, what we do get to see that because the demand falls, the demand falling leads to the fall in inflation and also leads to the fall in interest rates. When the demand increases, you will see a slight bit of increase happening, gradual increase happening in the inflation, and also happening in the interest rates. Now, just briefly skipping a few slides, because I think this is something which you will have to look at by reading through. I will be able to send you some notes across specifically for the UK economy, wherein the idea would be to try and understand the fiscal and monetary policy from our perspective. Now, one of the key things which I would point out is there was a concept called QE, quantitative easing. Because the UK economy was in recession during the financial crisis, along with some of the other countries, what the bank did was, because the money supply became short, the demand was contracting, the Bank of England essentially pumped money into the economy to make money available. And this was primarily done to kind of help businesses borrow money at a lower interest rate so that it could try and boost the demand of goods and services in the economy. So quantitative easing was basically nothing but based on John Maynard Keynes, which is a British economist, where he had actually proposed a theory which talked about that the government can use these fiscal the instruments or policies to influence the macroeconomic activity in a country. And that would mean that they could influence tax levels and public spending by putting more money into the economy, and that is where QE or quantitative easing actually comes in. Now, going further, when we want to understand, say for example, let's put it this way, I'm going to go back to the slide wherein I want to take up an example here. Now, what happens when an economy slows down? What you will see is that if the economic engine or an activity of the country slows down, you will see that a lot of companies would start to make people redundant. That means they will start to lay off people because they do not need enough people now to produce goods and services, as the demand in the market is not there, and that tends to drive the unemployment levels up. Now, when unemployment levels go up, consumer spending goes down, because if you do not have a job, you have no stable income coming in, you will not be spending that much of money as compared to when you have employment or money coming in when you are in employment. And here, then what happens is, because the money is not coming in, the products and services are seeing a contraction. You will see that the businesses also, to a certain extent, they stop making money, or their revenue or their profitability begins to go down, because the company would then invest into other promotions to try and increase demand. But if it doesn't happen over a period of time, then this leads to businesses also making lesser profits and less money coming in. Now here, then in order to drive the demand, the government will actually try to do some tweaks. And these tweaks can happen through the use of fiscal and monetary policy. That means in the market money, they would kind of give you a decrease in taxation, which would mean that if the level of tax decreases on the income that you're making, then you have more money in your pocket because you're paying less tax, and you'll be able to get that additional spend happening because of taxes being saved. And what they try and do is they try and kickstart some of the public sector projects, things like development of infrastructure, roads, schools. They spend money in those kind of, public sector enterprises, so that it is able to then create demand and drive or boost demand primarily for these services. And that would mean people will start to get employment, and employment creation then allows to have basically allows you to have money in your pocket, which then tends to drive demand as far as the economy is concerned. Now here, what that means is, if you are getting jobs which are government jobs, then in those cases what happens is the jobs which the government creates by the tweaking of these policies helps drive money or wages into your pocket, and as a result what you will get to see is the economic level or the activity begins to rise slowly and gradually, and that would mean the unemployment would fall. So in the quantitative easing example which the Bank of England did, they pumped in over in 2 or 3 phases over 400 billion pounds into the market, was that they wanted to make cheap money at very low interest rate available to companies or the banks, which in turn could lend to private sector organizations, and these organizations then started large scale developmental infrastructure projects which created employment, and that creation of employment essentially meant people were getting back into employment, and when they got back into employment they had money in their pockets to spend. That kind of drives the demand and kick-starts the economical engine to reverse the cycle. Now if we look at sometimes when the when the inflation or when the prices of goods in the market begin to rise, and it remains it rises consecutively quarter after quarter or week after week, then you do get to see, if the inflation rises very high, then the economy also slows down. Now example of that would be Zimbabwe, wherein the currency of Zimbabwe did not have any traction because of sanctions, or any country which is under sanctions currently. What tends to happen is the convertibility in terms of its currency reduces in the market. Nobody wants that money, nobody is going to that country, they do not have any foreign income coming in, and because the income is not coming in, the currency which you use within the country is not able to buy enough goods and services, and that means that the prices of goods and services at a particular shop counter, they begin to rise. And when they begin to rise, what happens is it leads to people not being able to afford to buy certain things, and when they cannot buy, what happens is, even though the goods are still there, the people have money, but they do not have the relevant money to be able to buy goods and services, and that is where you would see that over a point in time, if the inflation does not reduce, you will see that the economy begins to slow down. Now, in those cases, what the government does is, every government has a target. The central bank or the main bank, Reserve Bank, central bank, whatever you call it, or every country is given a target by the government to maintain inflation or keep inflation below a certain percentage. Now, in the UK, the central bank or the Bank of England essentially has a target of maintaining inflation at 2% or lower. Now, if the target is not met, then the bank is supposed to take appropriate measures to be able to reduce the inflation and bring it down at 2% or below 2%. Now, there are lots of things which the banks can do, and this thing these some of the activities which the central bank or the Bank of England actually does to reduce inflation is it does this by controlling the circulation of money in the market, and it also tries to kind of then influence the government fiscal and monetary policy, so that those instruments also help it to kind of reduce the circulation of money in the market to an extent wherein it then brings the inflation down, or starts to bring the inflation down. Now, they also do forecasts. Now, the Bank of England makes quarterly forecasts in terms of how the economy will fare, and basis these forecasts, it kind of sets certain let's say it sets or give directions to the market, saying that this is the condition of the economy, this is what we see happening in the next 3 months, and that helps to drive the what do you call the trade markets or the stock markets, and then they produce favorable results in terms of either the currency remaining stable, going up, going down, and things like that. So these are things that we need to understand from a point of view of understanding the effect of fiscal and monetary policy, and the central bank or in countries, or the Bank of England in the case of UK, uses some of these policies to be able to uses these policies to be able to influence and maintain the rate of growth and obviously the inflation figures or the targets which it has been given by the Parliament. Now, one of the activities that we can do would be to look at a macroeconomic analysis for a particular country and a particular industry within a country, and we use pestle analysis to see how it affects what factors and how these factors affect the economy in terms of its that particular business. So here my suggestion would be to look at doing a task which basically talks about doing a pestle analysis, which is political, economic, social, technological, legal and environmental on a particular industry within that country. So in the case of UK, you could try this out for, say, the construction or the house building industry. Now, this is a video which typically I was playing earlier, and this is something which is you can watch to understand how the economic system in a particular country works, and what are the key factors that we've covered in the slide would be covered in this video. So it's a good watch, and this will give you some good background in terms of how the steps taken by the earlier Prime Minister Gordon Brown and the Bank of England Governor Mervyn King put the economy back on the growth path, and how Britain recovered from recession. Now, very briefly, looking at learning outcome 4, because we need to extend some of the learnings of the learning outcome to, in terms of the government policies and everything, into understanding international markets and policies. What we want to look at is basically 2 or 3 things. Now, how do you think businesses are impacted by policies from different countries, and how does it impact international trade? Now, here you have to understand that a lot of companies, we took an example of Marks and Spencer, Tesco, some of the companies which are global in terms of their operations. We need to understand that a lot of these businesses which provide or sell goods and services in different countries, but produce them also in different countries and then import them back or export them into countries to sell, would also have effect, would be clearly affected by the law and legislation in different countries. And this is what is called the international internationalization of business, or the impact on the business because of different legislation which it has to follow to be able to comply and then sell the goods and services in that country. Now, some of these businesses have global marketing, and they tend to market products and services in a particular geography which meets the culture and the environment of that particular country. Now, what you will get to see sometimes is that a lot of businesses now which are global employ a lot of different type of people, and these people come from diverse backgrounds and culture. Now, here, in order to understand and make this work from a business perspective, what we do get to see is that businesses essentially have a lot of interdependence on the law and regulation of different countries to be able to trade effectively. Now, in tandem, when we look at is, say, for example, in the case of European Union, UK businesses, EU is a part, UK is a part of EU right now, and what we did was we signed on to a lot of treaties, or we signed on to a lot of policies which are now part and parcel of UK law. So here it allows the companies to trade seamlessly with countries in Europe. When I say that, is that the normal barriers that you will get to see in terms of customs duty, excise duty, and these kind of things have been done away with, because UK follows a custom union, for trade purposes with the 27 different countries in the European Union. But when we exit and when we come out of European Union, what will happen is, what we do get to see in the news is the Prime Minister is trying to negotiate favorable terms of Brexit, so that UK, although being outside the European Union, will still have access to the single market, as we call it, or the trade with different countries. And these trade barriers, will not, which were kind of broken down when we signed into the European Economic Area, will continue to be there, and that will allow British businesses and businesses from other European countries to be able to export and import goods and services into UK. And that would lead to minimum disruption of business, because the physical barriers like the border and obviously customs duty and things like that will not be there, and we will sign into or maybe get a deal with the single market that this is what the trading terms will be. And in case of trading terms, as long as you pay these duties or whatever it is, I think nobody knows what will be negotiated. But if you manage this and do this, then it will still allow you to, have access to the market. But outside the EU, India and China, for example, which are the other two countries which we want to do deals with, we will have to follow World Trade Organization or the other side of organization which has, defined laws and regulations into, for trading will have to be done. So that means UK will have to sign into something called the WTO, World Trade Organization, and we'll have to adhere to their laws and regulations to be able to trade into countries which are signees to World Trade Organization. Now, how does this impact? When we look at companies which are operating globally, what we do get to see is a local, customs, cultures, the goods and services that you sell in that country have to be looked at structuring into the business. So when we look at, say, for example, a lot of European countries which have an example here in particular would be they produce pork or, pig meat, and then they export into countries. But this is not exported into countries which are countries which have Islam as a faith, because that is forbidden. Now, if a company is to export that into that country, then what will happen is, one, obviously there will be some repercussions or sanctions placed by the country, the government into the other countries, say UK countries government, or in certain cases what they will do is when they import, the quantities could be regulated so that it is not provided into wide scale distribution in that market. Now, because the businesses, when they are global and they deal with different customs and cultures across the geographies or across the countries, here they have to keep in mind the various aspects of the requirements. So there's a term which is called global and local. The term combined now used is called local. That means you are global in terms of operation, but you are still localizing your goods and services to be served in that particular country, wherein you take care of the culture, the diversity, the background of the people and their buying habits to produce goods or supply goods which meet the global supply chain requirements at your end, but also meet the local requirement from the consumer's perspective. So that term called local. And here is where they look at the, where we look at studying the significance of international trade on businesses, because a lot of businesses will have to tailor some of their products and services to be sold in a country. Now, let's look at, say a country like, the company like Tesco, which now is selling goods and services in 12 different countries. Now, in order to build favorable trade practices or business practices, for example, in a country like India, wherein they felt that price is very sensitive and some of the goods and services which Tesco provides might not be able to compete with the local sellers in that country. So what Tesco did was, instead of going directly into the market, it created a joint venture. And we studied joint venture or JV yesterday. It created a joint venture with one of the companies in India, and that allows it to go to market in that country. That means they have a local partner which understands the requirements of the consumer, knows the laws and legislation of that country, and Tesco brings in the expertise on supply chain distribution and then works with that partner under a joint venture to be able to sell its products and services in a large country like India, which they cannot ignore for international trade. So Bharti Walmart, for example, which is a company in India called Bharti, and there's a Walmart, obviously the world's largest retailer, they have tied up. Similarly, you have Tesco and, Reliance, which have come up together to offer these products and services in the Indian market. And that has kind of helped Tesco to do international trade in India, or Walmart to do international trade in India, because this is a big market they cannot ignore. And this allows them to procure some of the raw material to be sold in the stores from their local partner with which they formed a joint venture. Now, very briefly, looking at how do policies affect, companies. So even I know that you're trading with different countries and different regions. How do policies affect? Now, we are looking at just understanding the impact of European Union's policies on UK businesses. So here, what we do get to see is that EU businesses, or EU as a country, is a member of European Union. And because we are a permanent member of the European Union, what tends to happen is when any policy or legislation or law is passed, the British Prime Minister also has UK has a seat, and obviously they have an opinion under which they can accept, choose to debate, or choose to reject a particular policy which has been created. Now, when this kind of an agreement tends to happen, what we do get to see is a lot of countries debate and they come to favorable terms which allow businesses to operate, and businesses to operate favorably. So here we do get to see is that being a member of European Union, UK is able to create or work on favorable policies which are in the benefit of UK businesses exporting to other countries in the UK, in the EU. So this particular part, which is looking at getting into creation of favorable policies, which allows no negative effect on businesses in the UK, allows UK companies to follow the legislation set in the EU rules to trade, but at the same time allows them favorable conditions to be able to trade with businesses, because thanks to the government, which kind of negotiates and works and debates on these policies to create that a policy which is favorable to both sides. And in this case, what tends to happen is, because we are a part of EU and we are exporting to EU as a company or as an economy, we do not pay any duties or taxes, vice versa with the companies in other countries exporting to UK. So there is a bit of a give and take which tends to happen, and that means the UK government chooses not to levy any duty on the goods and services coming to UK for sales from other European countries, and in return the European Union allows UK businesses to sell into other countries without levying any duty. So this particular process, which allows kind of a neutral platform, can be achieved when we see the government of UK, the Prime Minister of UK, sitting down with the EU members to come to a favorable decision in terms of policies being applied across to products and services being sold by UK companies abroad and from abroad into UK. Now, very briefly, this is something that we need to understand, is that when we import goods and if the exchange rate is high, what happens is you will see that the imports, when the exchange rate is low in terms of comparison to dollar, we see imports increasing because our goods and services become cheaper in the international market, and that would mean that it becomes favorable for buyers to buy from us. Now, if the exchange rate against the dollar increases, our value decreases in terms of currency in the market or increases in the market. And what that means is, if it's a stronger pound, you will see that the imports are affected, but exports become cheaper. Now, this is where it is of interest to the business organizations to decide on whether they want to import or export, or they want to produce locally or produce overseas, and that allows them to kind of balance their trade-off in terms of products and services. So an example here would be, when the pound becomes strong, the British companies which are importing goods from outside, they become cheaper because the pound is able to buy more, for each pound as against because of the increase in currency. So, example, 1 pound is equal to, I think, 156 Pakistani rupee. Now, when we have to buy something from Pakistan, what happens is, if the pound is stronger, we can buy more in terms of its real value from companies which are in Pakistan. But if the pound reduces to 1:120, that means the same pound is now worth less, and that would mean we have to spend more to increase, and that in turn, if I look at the opposite, exports from our side become cheaper. That means companies which are trying to sell abroad, if the pound drops to 120, then it becomes more affordable for companies in Pakistan to buy UK goods and services. And that is where, some of the policies have to be understood when we work with World Trade Organization and when we work with European Union, and the government closely monitors, the fluctuation in exchange rates, so that because it affects the import and exports happening from the country directly. Now, what I'm going to do is I'm going to try and stop here. It's been quite a long session. What I want to be able to do is send you a copy of this presentation with handouts for yesterday, handouts for today, so that you can study some of these in a bit more detail, and also refer to the chapter in the book, which primarily under business environment, to try and understand some of these terms and terminology that we've studied and develop a bit of a deeper understanding as far as the learning outcomes are concerned. Now, if you have any questions, please feel free to email them to me today. And what I will do is I will try my level best to come back to you with some more details, or will point you in the direction of the book to read some additional pages so that there is a clarity on some of the things that we've discussed. Now, the last bit would be, if I just stop